Okay, hi everyone, Daryl here. This is lesson 44 in my YouTube playlist Investing 101. And today we're going to talk about this market phenomenon called the January effect. And I think it's kind of useful because if let's say we're investing in stocks, we should actually understand that the markets are not always efficient. And to be very frank, this is something which I've kind of used in theory before. So that means that I actually entered the stock market based on this particular theory and then managed to, get a little bit of profit and pick up something good during January. Okay, so what is the January effect? It's actually the seasonal increase in stock prices during the month of January. So there's usually a slight rally in January. Uh, what's the main reason? Actually, this follows a drop in stock prices in December because investors, right, what they tend to do is that for the end of the year, they want to book in their capital gains for the year. So they actually sell off their so-called winners, which is the counters which actually make money. So what happens is that if let's say this particular stock which they've invested in, right, makes money, and then in December the price is relatively decent, they actually book in their profit, so they sell in the market, and then after that they book in the profit, and then this usually causes December to be kind of like a weak month for stocks. Okay, next thing, right, is that investors may be using their bonuses to invest in stocks. So end of the year, uh, if they are employed, then the company may pay them bonus. So end of the year, they take their bonus, then they say, okay, I'm going to invest in stocks in in January when I receive my bonus in December. So one thing is that some people may say, I have a New Year resolution to start investing. Then they say, oh, okay, since New Year resolution, right, then I invest in January. The same reason why normally like the start of January, right, you see an increase in number of people in the gyms. So if you go to the gym, you realize that in January normally a lot of people are in the gym. That's because they have a resolution to start keeping fit. There are also people who have a resolution to start investing. Okay, and one thing is that based on what happens in December, so a year-end sell-off may make stocks more attractive in January. Sorry, I have this typo here. Okay, so a year-end sell-off may make stocks more attractive in January. So typically, if I see a December that is performing very bad, I may consider entering the market in January, which is what I did on a couple of occasions. Okay, and this is actually considered a market anomaly, like not operating properly. So like a calendar effect. So there are many calendar effects in the stock market, and it actually shows us that markets are not efficient. So for us, it is always important to understand all this because we can actually profit from market inefficiency. So yeah, so these are all psychological things which actually influences the stock market prices. Okay, so in spite of what a lot of people say, a lot of people actually come to me and say that, oh, I'm actually a value investor, which I invest in things which I think hold good value. But then when I ask them, so what you invested in, then they say, oh, I bought this, then I sold this, then I bought this, then I sold this. But typically 99% of the people, right, who call themselves value investors, they are still in the stock market to make money. So how they make money is actually through the sale of their stocks for a profit. Yeah, so we need to understand this, and we need to understand that in December there are people who want to book in their profits and they start selling. And so for us, if we actually can track that December was pretty bad, we can actually use this theory to enter the market in January. Okay, and so this January effect, how often does it happen? So for the Standard and Poor's 500, which is a S&P 500, which is an index which um, tracks certain, uh, tracks counters in US top 500 based on S&P. So actually in 1928 to 2018, it rose in 56 Januaries out of 91, which doesn't really show a very, very strong correlation for January effect. But normally what happens is that in the event that December does pretty badly, right, you can usually look to January to enter the stock market if fundamentally everything is sound. So fundamentally, nothing actually happened in December, nothing happened in January. Then if December caused a market correction, then usually for January, the market may rebound based on the January effect. Okay, so just take note, usually happens for small cap stocks, but personally for myself, I've always looked at counters in January, especially if the December has been pretty bad. Then I've managed to enter counters in January at a very, very decent price. And so this is something which I think that if let's say you're in the market and looking to invest in stocks, try to remember this. There are certain periods in the year whereby we may want to look at the stock market and then try to analyze and see whether we can find some anomaly so that we can profit from them. Okay, so that's all about investing, right? So if you invest in properties or invest in stocks, you're always looking for a profit. Okay, and yep, so that's all for my presentation for this week, and I'll see you in the next video.